There we go. There we go. That's a lot better. Okay, so now you've seen some our disclaimer. We'll just kind of get right into it here. But thanks for tuning in. And I'm Doug Shreve. I know down here at the bottom it says Keith Tyner, but Keith is living the dream today. He's enjoying some time with his family. And so I'm here. I'm coming at you live from Gimbal World Headquarters, which is probably the best place to work in the United States because we have a beach cruiser back here that we can ride over and get some coffee or lunch and just exercise the legs to get out from under the desks. So that's always pretty nice. Want to tune in to a couple thoughts today. I thought we'd walk through the stock market like we always do. And then I want to get into a little bit of a financial planning discussion with you. And that financial planning discussion, I've basically just titled it, living the dream. And living the dream could be defined differently for you than it is for me. It's built up alongside of the way you see the world and your experiences, the things that you enjoy, the things that you just don't. And there's really two phases. There's two phases to the financial planning process. And I credit Nick Murray for this. Nick Murray was an investment advisor himself. And then he was really one of the pioneers who started to pour into people like me and people like Keith and help us think through how to better serve our clients. And so Nick Murray talks about two different types of phases. You have an accumulation phase and then you have a distribution phase. And so we're gonna dive into that. But let's go ahead and let's do a market check. Let's take a look and see how the markets have been looking this week. And we'll start off with the Nasdaq. This is a weekly picture of the stock market, the Nasdaq, which is 3,500 or so stocks, individual companies. Most of these companies are growth-oriented companies, meaning that they're pouring resources and revenues. They're investing back into themselves. Maybe they're buying a company, maybe they're growing by merger or by purchase, or maybe they're just taking the money that they're making and they're doing increased R&D. Whereas when we look at the Dow Jones, which is 30 stocks, or the S&P 500, which is 500 stocks, those companies in those in those indexes typically are a mix. Some are growth, where they're reinvesting in themselves, and then some are focused on dividends, on shareholder return of income to the shareholder. So this is the Nasdaq, and as you can see, we've had a tough, really, couple weeks here in the short term. We've fallen off the highs back in July. And so your end of month statement in July would have looked pretty fantastic. July would have been the time when we were coming off the lows and just had a really good run here. And then we've been giving up some steam. Something that I know we talk about on this show from time to time, but if you just go back and you look and you say, wow, this 16212 number all the way up here, I'm circling my mouse on it right now. This was the peak. This was the high right around Thanksgiving 2021. And we've still yet to top that. And so it's, even though we've had a nice comeback here since the lows in 2022, we've still got a little ways to go till we get back to that peak of 2021. And this type of market action we're seeing here in the most recent weeks is just choppy. It's choppy because of inflation threats. It's choppy because stock owners thought, well, maybe the Feds are going to pause or be done on raising rates, and now that's a wonder. I think it was Jamie Dimon, CEO of JP Morgan Bank, came out and said he expects to see these higher rates for a little bit longer. That sent the market into a sell-off. And so that's what we've been seeing the last couple weeks now. I'll shift over to the S&P 500. Okay. This is again a weekly picture. Keith drew a green line here to show you an accumulation phase. And this was the accumulation phase that came out of COVID in 2020. And then you see these little green lines. There was another accumulation phase running up until December of 21, and that's where the S&P hit its high. And if I draw a red line across, we haven't hit that high. So similar to the NASDAQ, we haven't moved up to hit the high. So today the market is under pressure and there's competition to stocks, you know, treasury rates, savings rates, safe money type investments. They're paying more, and we'll get into a little bit of that. Let's take a look at the 13-week treasury. Now, this chart is really wild. But the most important thing for you to pay attention to is, see this number over here? It says 5305 right there. That tells you that short-term rates, 13-week Treasury bill index, is paying 5.3% interest. And where that correlates to your life or intersects your life is that means that your savings account, your checking account, your money market fund should be paying better interest than it was. And so you could see this rapid acceleration. Gosh, I don't know when I've seen anything like that. Well, you see this rapid acceleration, and down here, your money on your interest-bearing accounts, just it would have not been paying much. And so we've seen a huge increase in treasury yields, which creates competition for stocks. And folks are saying, well, instead of investing in the stock market, I could pick up 5.3% in a treasury. I'm okay with that. And so that type of competition has been putting pressure on the stock market. If we go out to a 5-year treasury, tying your money up for 5 years instead of 13 weeks, it's paying 4.5%. Again, it's a steady uptrend on yields. If we were to say, let's go out 10 years, hold your money, lock your money up for 10 years, 4.5%. And then if we could imagine a 30-year, 4.6%. Okay. Well, it wasn't that long ago where, again, this was, around 2. And so it's just been a big increase in treasury yields, the guaranteed yield rates. So that's just a quick checkup on the market. Sometimes we like to take a look at the VIX, which is a measure of the ups and downs in the marketplace. And you can see, just fix your eyes to the right. I'll switch out to a daily here. Fix your eyes to the right, and this is current time when we look to the right. And we saw a spike up in the VIX, and we've seen that when the stock market's gone down since July, we've started to see this spike up. And I wouldn't be surprised to see that continue. Maybe it continues somewhere around this 25 level. But ideally, if it could just level off and hold tight here for a little while, that could be good for the market. I know many market forecasters are looking forward to the fourth quarter to see what company earnings and results are going to be, to see if earnings and profitability helps boost shareholder price and value. But we won't know till Mr. Market tells us. Anything beyond what the market is saying is a forecast. It's a guess, and analysts are paid to guess. Some analysts are better than others, but the best thing we can do is just fall in line with what the market is giving us. And right now, it's not giving us a whole lot. And so those safer investments like a money market or cash have been pretty attractive here recently. That's a checkup on the market. If you have concerns or you're seeing opportunity somewhere, I would love it if you would email me or call me and let me know what you're thinking, what you're seeing out there, or what you're concerned about. And then I'd like to have a conversation with you on it to dive in a little deeper on your personal situation. But the the thought process of accumulation and distribution crossed my path this week, and I was just thinking about it, and I thought I'd share some thoughts with you. Where are you in this? Okay, for the most part, for those of us who are somewhere, I'll say 20 to age 50, and I know that's a generalization, but you're thinking accumulation. You're thinking, all right, I've got some responsibilities. I just got married. Uh, we now have two cars. I mean, you're in this growth phase of life where things are stacking up. Um, I have a joint checking account now. It's no longer just me. All of a sudden, we have kids, more kids. We probably need a will. We need a bigger apartment, maybe a home. This accumulation phase, you're just adding stuff. Um, you go along and you have increased responsibilities. You start adding a 401k during the accumulation phase. You start investing for growth in the accumulation phase. You're looking for things like those NASDAQ stocks that are in growth mode themselves. You might consider, well, what do my insurances? How does insurance fit into this accumulation phase? And so you're protecting with term insurance. You are protecting with disability insurance in case something were to happen, and you no longer have the income acceleration due to a health reason. So a health savings account. You're accumulating money in a health savings account. It's starting to stack up. You at this point in time probably are looking at a bigger car because you've got more kids. You're maybe considering a bigger home. You have increased cost in so many fixed areas. You have a college account. Maybe you start an investment account beyond your 401k or your IRAs. You think, well, what if we took some money out of our savings account and started investing that so that we have another pile of money that's different than the tax sheltered 401k? Maybe you start dreaming about land or having gold or silver or something different than stocks in your portfolio of wealth. You start acquiring a garage full of bicycles. I know that happened to us. You start taking a look at another refrigerator because it doesn't it's the current one that you have. You need more space to keep up with the kids, and the grocery bills are going up. The You start dreaming of taking trips to Disneyland or a lake house someday, or maybe a country club membership, or pool membership, or going to Colorado on ski trips. I mean, you're dreaming. Your dreams are being funded by accumulation. You're moving forward, and we see that a lot from those right out of school years to about age 50, and then right around age 50 something starts to happen, and that thought process kind of begins to develop change, and that change is, okay, I've got another 10 to 15, maybe 18 years to grow wealth for my retirement, and maybe I slow down on some of these expenditures. I already have a house, my cars are good, we've got things in motion. And so that 50 to mid 60s, you're thinking through, hey, purposeful assets. I've got a window of time here to make it happen. And during that window of time, maybe some of those expenses are decreasing. Maybe you're not filling up the second refrigerator as fast as you once were, or you're simplifying your automobiles from a huge gas guzzler to, something that gets a little more reasonable mileage. But you're really starting to think through what will retirement look like for me? And and those, it's a great time of life. I'm almost there, and I'm really enjoying this stage of life. Just thinking, what will a really great retirement look like? Keith defines retirement as doing what you want to do, and that could be through work, that could be through volunteerism, that could be from just pouring into your family. But what does retirement look like? And I thought I would share a little bit of successful distribution. And so in retirement, that's what you're doing. For the most part, you don't have that income spigot of a W-2 or a 1099. It's the distribution phase. And I've never experienced that. I will experience that hopefully someday. But I wanted to share with you some secrets that I've observed from being in this seat and that I've seen from people who have retired really, really well. And it's so admirable. And the folks that I see that have retired really well, they worked a plan and they kept it simple and they've got a vision for their life. And it's something that is unique to them. There's no duplicates out there. And so it's something unique to them, but there are a couple things that I've seen that people have in common. And it really boils down to this. They're owners. They're not loaners anymore. The house is paid off. The cars are paid off. They don't have the debt parachute that maybe the person in accumulation has or is tempted to have. But they own stuff. And so they don't have those headwinds where they need to keep growing their income or keep growing responsibilities to pay for things. Most of the successful people that I've seen during retirement, they waited to take Social Security. Now I know everybody's situation is different, but you know, the, if you take it at 62 and you live to be 85, you missed out. You missed out on some extra income from Social Security. So a lot of folks that we know and we've seen do life successfully, they begin having that Social Security conversation right around 60, 62. But the idea is, hey, let's wait. Let's extend that out. And so maybe it's 67 or maybe it was 66 for you. Maybe some of you said, I'm going to wait until 70 to start taking Social Security. But that I've seen successful people wait. The successful distribution plan does take income off their investments. And that income changes and it needs to be addressed and needs to be spoken about. It needs to be spoken about with me or Keith on a regular basis. What does that income look like? Because like we talked about in the treasuries today, money market today is paying right around 5%, whereas not that long ago it was paying not even 1. And so a successful person in the distribution and the retirement phase of life understands that income fluctuates. And there's going to be times where the income is going to be better off your investment portfolio than others. One of my friends, who is a client, and I just love this guy. He spoke this into me. He had 3 buckets when he retired. He had his safety bucket, he had his income bucket, and then he had a growth bucket. And the growth bucket was a lot smaller than the safety or the income. But when markets were good, he would take a little bit more off the growth. And he would use that to supplement his Social Security. He would use some of the income. He would kind of let the safe stuff ride. But when markets were bad, he would say, well, I'm going to pull a little bit from my safe money. And that safe money would be the treasuries or the CDs, stuff like that. And so I always liked his flexibility where he could pull from different resources. It's almost like if he was self-employed and he had a couple businesses. If one business was doing great, he'd pull a little bit from there. Or if one business wasn't doing so well, needed capital, he would seed it. And so having a plan for your income is a big deal. Having multiple sources to take money from, that's great. And when I say multiple, I mean like you could have a tax deferred account. You could have a joint investment account. All those things that you were dreaming of during your accumulation phase, just having different places to take money from. The other thing that I see that's real, this is really interesting with successful distribution, successful retirement. This one just blows me away. Is the people who I see who are successful in doing this, they're still givers. And it's one thing if you have a few $1,000,000, say, yeah, I'm still a giver, okay. But I also see successful retirees who don't have anything close to that, and they're still giving. It's part of who they are. And that giving culture, I think, just it formats someone being okay with themselves. They're content. And so they might want to give back to different places that are important to them. And there's tax efficient ways to do this, yes. But it starts with the mindset is do I have enough for myself? Could I pass some along? And that giving could be, I want to give to my loved ones now. Or I have a good friend, she doesn't have children. She throws some great parties and she invites neighbors over and people, and she gives them an experience that they could not give themselves. She could have just kept all that money for herself, but she does that. And that type of give back, I think, is just is good for the heart. It's good for the soul. So giving, that continued effort to invest in other people or invest in other organizations that are important to you or the people that you love. That's a really neat recipe for success. I think the main thing to remember in all of this is it's a moving target, and you're going to have years that are better than others. You're going to have situations pop up in life that you know you kind of knew could happen, but you didn't really plan for. Some of that type of stuff is related to your health and health expenses. And whether you're in the accumulation phase or you're in the distribution phase, the healthcare costs that can be a real tricky one. And if you're thinking through that and you want to have some ideas or experience that Keith and I have seen, we'd be happy to share that with you. But anyway, I hope you've enjoyed this discussion on the accumulation phase and the distribution phase, a successful accumulation phase. If I could sum it up, I would say, you know, a successful accumulation phase is not living too big, not getting in front of your skis. A good friend of mine, he used to say, there's a crowd out there called the extend and pretend. Don't be in that club. But just start building just the riches of contentment in your life. And during the accumulation phase, it's cool to go to Disney. It's cool to want to spend some money. That's fine. But just having that mindset of this stuff doesn't really define me, and so therefore I don't have to get ahead of myself or have what the Joneses have. And then during the distribution phase, again, I think one of the secrets is just to dial in your expenses, combinations of Social Security. Maybe you have a pension, but it's a combination of Social Security and a reasonable distribution plan. And we can help you get those things on paper. We can help you dial those things in from year to year. Love to do it. So that's the update on the market and retirement planning in general. I hope you have a great weekend, and I'll look forward to seeing you next week. Okay. Bye-bye.